If you live in Australia and have a home loan or investment loan, you might be familiar with redraw facilities and offset accounts. But did you know that parking money in redraw facilities could cost you thousands of dollars every year? 95% of people don't know it, and a lot of bankers and brokers don't even realize it. Watch this video until the end, as I guarantee you'll be glad that you did and will want to pass this information on to your families and friends. First, let me explain how the wonderful benefits of redraw facilities lure people straight into the trap. A redraw facility is a commonly offered feature with home loans and investment loans, allowing borrowers to make extra repayments on their loans and then access those funds later if needed. It provides borrowers flexibility and peace of mind, knowing that they can access additional funds they've contributed towards their loans in case of emergencies or other financial needs. In terms of saving on interest, redraw facilities offer the same benefit as offset accounts. When money is parked in either of these options, it effectively reduces the outstanding loan balance on which interest is calculated. That means more of your regular repayment goes towards paying down the principal. You'll pay less total interest over the life of the loan, and you will get rid of the loan sooner. What's more, some lenders charge additional fees or require higher interest rates for loans with offset accounts, which increases the appeal of a redraw facility. See, 95% of people think this is a whole story, and those are perfectly good reasons to park money in a redraw facility. But if they had known what would happen after they withdraw the money from the redraw facility, they would have wished they had made a different choice from the very beginning. Enough of the telling, I'm going to show you with two real-life examples how parking money in a redraw facility can cost thousands of dollars and more. These examples represent two different but very common scenarios in Australia. John owns a principal residence with a home loan balance of $500,000. With a family member's passing, he inherited $300,000. John has no offset account on his home loan, but it does come with a redraw facility. John decided to reduce his loan to $200,000 using the inheritance, thinking he can always get this money out using the redraw facility if he ever needs it. John now only needed to pay interest on this reduced loan balance of $200,000. Happy days! Not long after, John got married, and with a baby on the way, the young family sought to upgrade their home. John decided to utilize the redraw facility, withdrawing $300,000 to serve as a deposit on their new principal residence. Consequently, their original home was turned into an investment property with a loan balance back at $500,000. Here comes the shocker. During tax time, John's accountant broke it to him that even though the first property had been converted into an investment property, only the interest on $200,000 of the $500,000 loan balance is tax deductible. At an interest rate of 6.5%, John missed out on a tax deduction totaling $19,500. With his marginal tax rate at 45% plus a 2% Medicare levy, he found himself paying an extra $9,165 in taxes. If John had parked this $300,000 in an offset account, none of these tax shocks would have happened because money inside an offset account remains his, just like money inside a normal bank account. However, money inside a redraw facility is not quite the same because any deposit into the redraw facility is considered paying down the loan, and any withdrawal from the redraw facility is considered a new borrowing. Whether you can claim interest on this new borrowing as tax deduction depends on how you use the money. If you withdraw money from the redraw facility for income-producing purpose, such as buying an investment property, yes, you can claim interest as a tax deduction. If you withdraw money for personal use, such as buying a car, going on a holiday, or covering everyday expenses, then you cannot claim a tax deduction on the interest of the new borrowing. In John's case, he withdrew $300,000 from the redraw facility to buy a principal residence, which is for personal use. It doesn't matter that the security behind the loan is now an investment property. Whether he can claim interest on the new borrowing as a tax deduction all depends on what he was using the new borrowing for. Hey, before we move on, like and subscribe if you find this information valuable so far. Now let's look at another example. Emily doesn't have a principal residence, but she does have an investment property with an investment loan balance of $100,000. She saved up $50,000 hoping to get a new car. Since she hasn't settled on which car to buy yet, she decided to park this money in the redraw facility of her investment loan. After all, the interest rate charge on her investment loan is higher than any interest she could have earned through a high interest savings account. She was convinced that parking this $50,000 in the redraw facility was a smart thing to do, as she not only needed to pay interest on the $50,000 loan balance. Shortly after, Emily found her dream car and promptly withdrew the money using the redraw facility. Her investment loan balance then returned to $100,000. Surprise, surprise, Emily also received bad news from her accountant during tax time. Emily can only claim interest on a loan balance of $50,000 as a tax deduction because the other $50,000 withdrawn from the redraw facility was considered a new borrowing. Since the purpose of this new borrowing was for personal consumption, Emily lost the ability to claim interest on that portion of the loan as a tax deduction. Even though Emily's property, the security behind the loan, has always been for investment purpose, the $50,000 withdrawn through a redraw facility lost its investment purpose the moment she used it to buy a car. If Emily had parked her money in an offset account, she would have achieved the same interest savings while she had the money, but maintained the investment nature of her entire loan upon withdrawal. What are the takeaways? Unless you are 100% sure that you won't ever withdraw money from a redraw facility for personal use, you should seriously consider having at least one offset account, even if it means that you have to refinance or paying a little bit of account fees or extra interest. Otherwise, relying on a redraw facility to park money with the intention of using it later can be risky. If you ever plan to convert your principal residence into an investment property or want to maintain the full tax deductibility on your investment loan. If you haven't parked any money in the redraw facility, thank goodness. I hope this video serves as a reminder not to make this mistake in the future. If you have and just realized you lost tax deductibility on all or part of your loan, I'm sorry to be the bearer of bad news, but wouldn't you rather know it now so that you can be proactive? Unfortunately, there is no quick and easy way to fix this, not even refinancing, but there are a couple of things that you can consider with the help of your accountant or advisor. If there is enough interest in these solutions, I'll make a video about it. So if you want to know, please make sure you leave a comment below. Thanks so much for watching. Don't forget to like and subscribe. I'll see you in the next one.